but it is very, very clear that that the market is still looking for nickel, and nickel is going to be paramount to any sort of move into that whole electrification space.
We'll start by introducing them. Andrew Penkethman, who you've already met today, is immediately to my left. Next to him is Joel Turco, who's Chief Development Officer at Wyloo Metals, and we've already had Wyloo mentioned 3 or 4 times, so we're looking forward to your opinion on your own company. Everyone else has had one already. Next to Joel is Darren Gordon, Managing Director of Centaurus Metals, who are developing the Jaguar nickel project in Brazil. Next to Darren is Dan Lougher. Dan, who you're representing Blackstone Minerals today, I believe, although he's got his Managing Director next to him, and so we've brought Dan on board for his vast nickel experience. How many of the nickel conferences have you been to, Dan? And then, of course, we have Scott, who will be joining us very shortly. Gentlemen, thank you for joining me. Again, I've got some questions, but you're going to have to give me a handout this time because I used a lot of my questions up in the first panel. I want to start really with a fundamental question, and Dan, I might even start with you on this one. I mean, as Bill mentioned in his opening remarks, we've had this conference when the price has been much worse than this in the past. Why is the Australian nickel industry in such dire straits at the moment, in your opinion? Thank you, Scott.
Sorry.
That's okay.
Okay, where do I start? Do you want a quick story or a long story? Look, to be honest with you, I think that we've pretty much overreacted to the whole scenario. And there's plenty of people in this room, Joe, Julian, lots of guys here that we saw nickel at 380 a pound, right? I checked this morning, it's $8 US a pound. Okay, we're a bit nervous, maybe it's rolling, you know, it's cyclical. But the bottom line, as somebody mentioned earlier on, that Indonesia cannot produce nickel cheaper than 15,000, right? And I can tell you that back in the day when I was selling concentrate to Tsingshan, and I sat in Shanghai, and the chairman, who we all know, you know, the LME shorter, said $10,000. Joe and I almost fell off the chair. And it did go below $10,000. But looking forward now, we are probably at a point where nickel is going to recover. I'm not sure if it's going to get to 30,000 as Andrew got, but it's going to get into some good territory. The issue we have now in Australia, and specifically in West Australia, the costs are too high. It's not about the nickel price. It's about the cost of mining and doing business in Australia, and specifically in West Australia. Smelter costs are 60% power costs. So how do you expect people to go out, contract costs, mining costs? They're just too expensive. As you know, Ed said, grade will pull you through. At the end of the day, cost is the only other thing that you can deal with. And I think that's where we've lost the plot. Yeah, going out to government for royalty grants and this grant and that grant. I don't think Western Australian government's actually done anything since Ed's 1970 smelter deal. So we're struggling a little bit against the rest of the world with, you know, trying to mine high-grade sulfides. Maybe we will move to the lower grade disseminated, and that's probably geologically the way things are going to go anyway. But to me, WA, we've lost the job of mining because I don't know why, but we're not mining cheap.
Thanks, Dan. Andrew, you talked a lot about cost and being cost competitive in your presentation. With your JV partners, how much of a focus is that going to be in the DFS, ensuring that you can get those costs to a level where you can be competitive with global peers?
It's an overriding priority. We had a weekly meeting every Thursday. Last Thursday, it was one of the key topics of discussion, cost engineering from the outset. We have a steering committee meeting, and that's the committee that manages KMPL. That was raised at the last steering committee meeting, and Dan's spot on with the increase in costs in Western Australia. Matt Longworth, Ardea's chair, raised it in one of the questions to the first panel and made the example that, well, with the iron ore sector and the fantastic margins they've enjoyed for many years, if there's a problem, is the temptation just to throw money at the problem? And does that raise the cost of doing business in Western Australia for everyone else? I think it's part of the challenge. I'd also like to see more from every level of government to assist the industry and make every aspect of us doing business more efficient, which is going to have a positive flow-on effect to being able to reduce costs. So there's certainly a role that government can play as well in amongst every organisation, tightening their belt and doing everything they can to manage cost.
Thanks, Andrew. Joel, obviously Wyloo took the painful decision to go on care and maintenance earlier this year. You've already started looking at restart possibilities. A similar question, really. How much of an influence is immediate cost, what your cost profile will be immediately, taking an influence in your decision making?
Yeah, absolutely. I think it's the primary focus for, to Dan's comment earlier, this isn't the first time that Australian nickel mines have experienced a downturn. In fact, you could say that's what characterises the Australian nickel sector, is periods of widespread downturn and then ramp up. And I think that the focus for Wyloo and I think for the whole industry is being resilient to those low prices, because you lose so much operational efficiency shutting down and restarting again, and you lose talent to other metals or other companies. So that's an enormous focus, what we do. We will campaign hard for green premiums and we'll look into government incentives where we can, but at the end of the day, it's about, to Dan's point, producing at a level that's globally cost competitive. Like that, there's no secret sauce to any of this. It's kind of the same story as it's always been. So obviously we look at different ways of doing that, but ultimately that is the focus. How can we be more cost competitive? Can we do that via different paths to market? Can we do that through sensible consolidation, be that at the corporate level or just through commercial partnerships and arrangements? But ultimately get bigger, get cheaper, and then you'll be able to compete.
Darren, you're obviously building a project now. Is cash costs, operating costs, the primary concern of how you make your project stand out as a investable, fundable operation?
Yeah, thanks, Dom. Thanks, everyone, for coming. Look, for us, it was the key criteria. I think the market probably knew that the Jaguar deposit was a large deposit, long life, but it was about showing where our operating costs sat and demonstrating to equity markets, but also potential partners coming into the project, that we are actually going to be in the market at all points in the cycle. And we were able to do that with the feasibility study. And, I think, again, touching on where Dan started with the conversation, power costs in Australia are really high. Power costs in Brazil, fortunately, are very low. So we've got a base where, 70-80% of the power in Brazil comes from hydro sources. Our power cost is going to be about 3.5 cents a kilowatt hour. Compare that, I don't know, I'm guessing 25 cents a kilowatt hour probably in Australia. So there's a massive difference in that cost structure that's enabled us to have a low operating cost base. And now it's about continuing to demonstrate that through the partnering so that we can get the project funded. But fundamentally, cost is the key. And it's been the number one driver through our feasibility study of demonstrating that we'll be low cost. So I think we're at about $3.60 a pound all in sustaining costs. So very, very low cost base. It's a project that will come on stream. I don't think there's too many projects around that would have a better profile than what Jaguar's got.
Scott, I suppose it's a similar equation for you. Your project in Vietnam, the immediate assumption is that it would be a low cost base.
Yeah, and very similar to Darren, we have very low power costs. We have hydroelectric power, around 7 cents per kilowatt hour. But we're also moving into the Manitoba region of Canada, where it's around 2 to 3 cents per kilowatt hour. So this low cost can be done in the Western world. So so it's about renewing your power source and getting those power costs down. But it's also that ability to go downstream cheaply, and unfortunately we just don't have that in Australia, and And that's, so for example, to go downstream in Vietnam, we're looking at sub $1 billion. The same refinery in Kwinana would be 2 to 3, maybe $4 billion. So that's the opportunity in the Southeast Asian region. But similar opportunity in the Western world, in Canada, where we're seeing a lot of incentives from government, particularly out of the United States. And so, unfortunately, in Australia, we are a long way from where the action is. And the action, I believe, is in South Korea, Japan and China, but also in the North American region with the IRA compliance and that sort of thing. I think the other big problem we've got is, and this is another sort of micro level, it's the mainstream media has a lot to answer for here, and this is not Paydirt, this is your local Bloomberg or Reuters. They've really just taken this to another level. Like, unfortunately, bad news sells newspapers, and it's just gone to another level. And I think, as Oliver said, like, where's the Reuters, Bloomberg guy saying how much money Nova's making at the moment? Like, unfortunately, that doesn't sell newspapers, and it's gone too far.
Darren, do you share that sentiment? Do you feel like there's the mood in the market is massively overstretched where we find ourselves as an industry at the moment?
Yeah, look, I guess the first-hand experience right now is talking to potential strategic partners coming into our project, and there's still no shortage of demand for long-term supply of nickel. And yeah, I think Andrew had the charts up earlier, and you just sort of see the growth that's still going to come. I think it's fair to say that the rollout of the EV thematic in North America and Europe is slower than what most people anticipated it to be, and that's probably been part of the impact of the negative sentiment that's floating around the place. That the market is still looking for nickel, and nickel is going to be paramount to any sort of move into that whole electrification space.
Joel, are you finding in your conversations with potential investors, potential offtake and so on, that these short-term fluctuations you mentioned earlier, it was ever thus with nickel, it was spikes and troughs. Can you approach it without looking at those spikes and troughs in the price?
One of the benefits of being a private company, I guess, is that we don't have to deal with the fluctuations in our share price, so it does allow us to take a longer-term view without having to worry about the next quarterly, so we're lucky in that regard. But absolutely, sorry, hear Darren chuckling next to me. Trust me, it comes with its challenges also. We also have shareholders, just not as many. Look, we are still seeing, the Ardea process and recent partnership with Sumitomo is testament to the fact that there's still a lot of appetite, even at what we think is close to the bottom of the market, for new supply to come online. What's that saying? In mining, we always overestimate the short term and underestimate the long term. If you were to zoom out to 40,000 feet, the demand story is still excellent. If you look at it over the course of decades, stainless steel demand might not be at all-time highs, but it's still very strong. Battery demand is something that no one ever expected. It's just we expected too much and have had to temper those expectations. So the long-term story is still very exciting, very compelling. And to Andrew's earlier comments, it's not we want it to be our mines, not Ardea's. The reality is we all need to get up, and there's room for us all to get up. But to your other point, it does allow us to take that longer-term, very patient view. We talk a lot in Australia about our mines in Kambalda, but we've got a great project in Northern Ontario that is a generational asset. To Scott's earlier point, a great location to be in if you want to move into downstream processing, and there's a lot of interest from international parties and part of the battery supply chain to partner on that. So no shortage of interest. You just have to do the work, in a deliberate fashion, and where you can take a long-term view.
Dan, Joel and Darren and Scott have all spoken about strategic partners and international groups. It makes me think that 20 years ago, when you first came to this conference, each of the producers that were here was a pretty standard sort of story. They were linked to BHP Nickel West. They sold their offtake there. Western Areas, of course, was one of the first that could pursue a different path, and you did so through China. Do you think the structure of the industry and those offtake contracts and where this WA nickel is going is going to change, is changing, is going to change dramatically over this next decade?
Yeah, I think that as Andrew's, the deal, the Japanese and Chinese and other Asian partners will always look for inroads into Western, commodity. We all know about the Russians and the Chinese in gold in Africa, so I won't go there. But the bottom line...
Yep.
Yep, okay. So the bottom line is that we have been driven into trying to get a strategic partner to fund things. Now, if you're private equity, you don't have to worry about that because you've got long-term shareholders looking for a return. And I think right now, we've already seen Centaurus coming in from Canada, getting, into Cannon Resources. And I'm actually quite surprised that we haven't seen more of that because if I was advising a private equity group right now, I'd be saying, let's get into the junior nickel stocks right now because you're getting it cheap, right? I mean, you're getting it, bottom price. And if you believe in nickel, that it's going to rebound up into the sort of, as I said, mid-20s, guaranteed. So I'm surprised the private equity is not jumping in. Dealing with the Chinese, of course, is depending where you are. Like Scott says, Manitoba and Canada, it's a big thing. But over here, I still think that the Japanese are a very good partner to have, and I think whilst we have some other political issue with China, but at the bottom line is when China, as we used to say back in the sneezes, we all get, and it's just shown recently the commodity prices rebounding on what they say. So I struggle why maybe we are so anti-China when all of our resource from iron ore comes from China. And until that drops off, I think we should just be getting on with it and being, straight carte blanche business. And they've always bought nickel from West Australia, and I can't see why they won't continue to do that and support this industry here. We just have to reach out. But coming back to some of the points made earlier, we've made damage to our own country. We've damaged our own nickel industry in this country, in WA. As Scott said, we've just chucked in the towel and went, oh my word, Indonesia, dirty nickel. Well, if you keep on throwing stones at other people, what happens eventually. And I don't think that will really add any value because we're not going to change it. They will sell nickel into China, Russia will sell into China, because they are the biggest dominant EV market currently on the planet. And I'm afraid to say Europe and America are not there yet. And Australia, we are a decade behind.
Thanks, Dan.
That's the truth.
Andrew, is it that dichotomy, that sort of black and white of Australian-owned nickel against Indonesian-owned nickel, or is it more nuanced than that?
Oh, I think it's far more nuanced, and at the end of the day, the world needs supply chain diversity and security, and that's where Australia's always going to be a shining light, and that's why I think our nickel will always be in high demand, notwithstanding we have to be cost competitive. So Indonesia's going to continue, but mining economics 101, and has been touched upon in discussions already. The lowest cost, higher value ore, it's been mined already. They're depleting their resources and reserves. Their ability to continue to expand at the rate at which they have done so far has been diminished. There's been a significant amount of ore being imported from the Philippines. So the timing's perfect for the Australian nickel sector to get on with the job, notwithstanding the equity market challenges. And there's no easy solution there, but inevitably the market has to turn. Presumably we're at or near the bottom of the cycle. I completely agree with Dan's comments. Like, now's the time to get set for the inevitable rebound in the nickel sector and the nickel price. But yeah, the Australian nickel sector is too important to the world to go ahead. And as we mentioned before, whether it's Kambalda style nickel sulphide project or it's an intrusion related nickel sulfide project, or it's a large laterite project. In Ardea's case, every mineral deposit's different, but the unique attributes of every deposit have to be drawn upon and maximised to see the projects developed in the best interests of all stakeholders.
Thanks, Andrew. Joel, go. Yeah, please.
I think on the Indonesia topic, when we talk about Indonesian nickel, there's a tendency to describe it as some coordinated diabolical scheme. And the reality is, maybe there's some truth to that, but I think it is a lot more nuanced. And when one country accounts for 60, 70% in projections of world nickel production, they have to be a part of the solution. I think that the last thing that anyone needs is to go, right, let's shut down Indonesian nickel. The nickel price skyrockets and it gets substituted out of everything. It's a bad outcome for everyone. But what should be concerning to any market participant is when 60% plus of production's consolidated in one jurisdiction. I mean, that's a big risk to your supply chain. I think it was just this week an Indonesian federal minister was asked about sort of bottlenecks in issuing the new ore mining permits, and he said, I have good news for any buyers of nickel. Our production is going to increase and the price is going to come down. So like, it's slightly concerning that we're openly talking about price control, because it's all good and well for customers when the price is low, but presumably if one country can control the price downwards, they can also control the price upwards. And I think that underpins the continued interest that each of our companies would be receiving in future offtake or partnership, because no customer wants that level of risk, been taking that to their board.
Scott, are you hearing that from the discussions with the investment groups and strategic partner groups?
Yeah, we've been working on the downstream partnership model for 5 years now, and through that journey we hoped that ESG would be at the highest level of priority, but unfortunately it's not. And it's always been cost first, and then the IRA came along, so that was second priority, and then third priority is ESG, unfortunately. And very disappointing, because we built our strategy on strong ESG credentials, and unfortunately cost is all that they're worried about. And I know that's not what people want to hear. And I think as an industry, I agree with Joel, we're lucky for Indonesia, because if it wasn't for Indonesia, nickel would be removed from the battery already by now. But as an industry, the damage to our reputation as an industry is very serious, and unfortunately I think that's going to be difficult for our industry to come back from, because these are the reasons why we struggle to attract capital outside of our industry. Like there's a lot of money on the sidelines, and they look at mining industry and they look at the bad news that comes out of Indonesia and they go, bloody miners again. And unfortunately, what's happening in Indonesia affects our whole industries, and so that is disappointing. And then unfortunately on top of that, the downstream partners or the players in the downstream, they don't care, because they are going out of business if they don't get that nickel price down. And so they are in survival mode, and ESG is the last of their worries at the moment.
Darren, in your discussions, I mean, do you market Centaurus and Jaguar as sort of an alternative to Indonesia, or is it a different approach?
I don't think it's as specific as that. I think, coming back to my original point, it's just about where you sit on the cost curve. So it's not about where your supply is coming from necessarily. The only caveat I'd say to that is that there are groups, and Japan's a big part of that generally don't want to go to Indonesia. Like, they've made it quite clear that they're looking for sources of supply outside of Indonesia. China obviously is already there. Koreans sort of, they're a little bit ambivalent as to where they are, but that's still the key growth areas for the nickel market, and really, particularly on the battery side and in that whole EV space. So, you want the North Americans and the Europeans to sort of take on and get more of the supply going into those markets, but they're a little bit in chaos, to be quite honest. You take a look at Volkswagen, for example, and I think that's more systematic of what's happening in Germany overall. But they're a massive car manufacturer. They should be leading the charge in respect to EVs in all of Europe, but they're really struggling to what is their model? Is it hybrids? Is it EVs? Where's it going? So you can't really go and rely on those markets right now to follow that path. All I can say is come back to the charts. Over the long run, you are still going to see and have the need for more nickel. I think the IRA side of things has still focused people's attention. I think right now there's a little bit of a hiatus because of the election and where that's going and who's going to be in power and what are the new rules going to look like. Is it the IRA? Is it something else? So I think we've got to get through that period of time to really have a sense, and then you might get a new push through from the North American market.
Joel, we mentioned, Scott mentioned in particular ESG and the green premium. Wyloo's obviously announced a partnership with Metals Tech around trying to develop some sort of supply chain. Can you talk integrity that then leads to a green premium, nickel premium? Can you talk us through that process and what it is you're trying to achieve?
Yeah, absolutely. I think one of the challenges with green nickel, and I'll keep using that because that's the easy way to refer to it, is that I think most of the global production of nickel at the moment that would qualify as green is tied up in long-term offtake agreements, and those agreements can span decades. So albeit the use case for nickel has changed a lot in the last 5 years, those agreements have not. They endure, and so that's a real challenge. So for a new nickel miner or if you're an existing nickel miner working on a new agreement, we understand through some of the work that these agencies have done that green premiums do exist, and they might exist in a number of forms. It might be a better price or an improved payability or another beneficial term, but ultimately it's reliant upon that mining company's negotiating power. Now, for most mining companies who are selling nickel via an offtake agreement, your counterparty is a global commodity giant or a global EV giant. So you probably don't have the whip hand as far as the negotiation's concerned. So what Metals Hub is doing is similar to what the LME benchmark nickel price is. It's a market-based reference point. The challenge is first defining what is green nickel. The criticism of green premiums is people say no one's willing to pay for a green premium. And right now, that's, to Scott's point, that's true, because if you're an EV manufacturer, you're worried about producing a car that makes a margin and can qualify for sort of mass adoption. But over time, as those costs come down, the only way an OEM is going to pay extra for an input is if it differentiates them in some way and they can charge more for it on the other end. And you can't do that unless you can guarantee, hey, I got this is certified green nickel. So the first step that we're working on with Metals Hub is what does that standard look like? Once you can get, and it might not just be carbon content, it might be labour rights and other associated kind of community practices. But you have to set a benchmark, and that will take some time. And then once you've agreed a benchmark, then you can, hopefully that market will mature into something that is a global kind of market-based reference point. Then all of a sudden you do open up a whole new world. People say, green premiums don't exist. They do exist. We have green aluminium. We pay more for free-range eggs than cage-raised eggs. So you have to be able to demonstrate that it actually is the thing you claim it to be, though. So, very excited about the MOU with Metals Hub. I think it's the first step. They work closely with the LME. They have a partnership there. We think it's about, laying the foundations for something that'll probably take a while to mature. We don't bank on it, like all of the companies at this panel. No one's relying on a green premium to get up and running. We're trying to get up and running on the basis of being cost competitive. But at the end of the day, if we're mandating EV adoption to try and save the world, it doesn't make sense to destroy the world in that endeavour. So something that I think will take a long time to mature, but is on the whole a good thing for our industry.
Thanks, Joel. Darren?
Just want to add to that. I think the one thing that got missed after all the chaos in 2022 with the LME is that they set a whole bunch of new rules for all this new supply to come into the market, but they didn't put any sort of green criteria on those units coming in. It would have been the perfect opportunity at that point in time to set the rules, but for them it was all about getting extra volume back into the market and trying to save themselves. So, you can still look at that point as a bit of a turning point and where the missed opportunity came from, because, if they really just set it at that point in time, we'd probably be a lot further advanced around the green premium concept. I think the other thing that will happen is probably in Europe, this green premium may also come in the form of the carbon tax. It's the CBAM rules that are going to kick in 2026 are going to have real meaning in Europe. And so if you are taking in commodities, whatever that commodity is, into Europe at that point in time, you are going to be paying. If you've got that high carbon footprint, it is going to cost you money. So you will get this point of differentiation over time, but it is going to take a little bit more time.
And the EU battery passport that's coming in as well, so more of that stick rather than the carrot. Andrew, what about your JV partners and the international groups that you've spoken to regarding green credentials and ESG? Are they prioritising that? Is that what attracts them to WA and to Ardea, or is it a sideshow to their main purpose?
Oh, look, obviously I can't speak for Sumitomo Metal Mining or Mitsubishi Corporation, but I can make the comment it was a key consideration in their project due diligence and decision to partner with Ardea on the Kalgoorlie Nickel Project Gungari Hub. So it was a whole combination of factors, but ESG was certainly one of the key considerations. And then going back further and making some general comments, Ardea's been running a strategic partner process for a number of years. We feel we have been able to collaborate with the best possible partners in the world, but bar none, just because of their resources sector experience, their track record of success in investing and enabling the Australian resources sector. So we see it as a huge independent tick of approval for the project and the ability for the project to be cost competitive with any of our global peers. And part of that comes back to the ESG credentials. But then more generally, we have spoken to a number of potential partners right around the world. I've been very fortunate to be part of a number of Austrade-led critical minerals delegations right around the world. And to come back to Scott's comment, the majority of potential partners you'd engage with, they would all talk about ESG, but it would tend to be number 2 or number 3 in their priority list, with, for most companies, cost competitiveness being the number 1 priority.
Thanks, Andrew. Right, it must be time for some comments from the floor. Other than Matt has been doing all the work so far, so hopefully we've got... have we got some comments from questions from the floor? Oh, yeah, we've got one just up the front here. Paula?
Thanks. I may be wrong here, but I think every company may have hydromet processing sort of as part of their flow sheets. Is that correct? Don't know. Maybe Centaurus, but yep, definitely Wyloo, potentially. You've looked at it in Australia. Obviously Blackstone, that's what it's all about. How important do you think that is to the future of cost competitiveness, I guess, going up against the, ferronickel sort of players?
Just before we answer that, thank you, George. That's George Ross from Argonaut. I'll just get everybody to announce who they are, just so we don't have any blow-ins, we're just trying to sneak in and ask some questions unauthorised. Thank you, George.
Yeah, I'll start. So when we went down the path of downstream, we didn't think anything other than hydromet from day one, and it wasn't driven by cost, it was driven by ESG credentials. And we're confident that we can do the downstream via hydromet at similar cost to a conventional smelting route, but more importantly at a much lower carbon footprint and a much better ESG outcome. So I think the beauty of the hydromet flow sheet for nickel sulfide is we've got flexibility on feedstock, so we can take high arsenic, high MgO, talc, throw whatever crap you've got in any part of the world, we'll take it all. So that gives us a real competitive advantage. We can deal with the byproducts easily as well, so we can get good, we can give good payabilities on your cobalt, because that goes into the battery, your copper, your PGEs, all of that. So there's a lot of flexibility around strategic, and it was a very strategic move to go to Hydromet. Our ability to also produce an MHP product, for example, if Andrew wants somewhere to put his MHP, more than happy to take it in Vietnam. So very flexible flow sheet. Unfortunately, the conventional smelting route is not as flexible, and I think it's a technology that was built for stainless steel. And so we had a blank canvas around nearly 5 years ago now, and we said, this is the perfect flow sheet / technology for the lithium-ion battery industry to convert nickel into downstream chemical products. And so, yeah, our view is, well, we've done a lot of work on this, and that we think this is the future of the industry for lithium-ion battery chemicals. And we welcome anyone who thinks better. Happy to say that maybe you might be able to do a little bit cheaper with the smelter, but the ESG credentials are going to, as we've said, like, don't be scared of what I said earlier. Eventually, ESG will pay. So we're confident of that.
Darren, did you want to tackle that one?
Yeah, I think in our situation, it's basically we're just too early to the party, to be quite honest. Like, we looked at the downstream, we looked at sulphate production on site. The couple of issues there, the green premium hasn't eventuated, so this premium that was in theory meant to exist for a sulphate product disappeared with the increase in supply coming out of Indonesia and the amount of supply of sulphate that they could have in their own right. I think that changes definitely over time. But it does have a number of economic benefits. The other side of it is, if you can produce a good enough quality concentrate, then that gap on your payables it's got to pay for itself, right? So there is an additional capital cost associated with it. There is additional operating costs associated with it. So you've got to have the right set of criteria in the right location, but you really do need to be generating this premium over LME to really make those sort of downstream works. Now, MHP and other things like that, for us, it didn't make a lot of sense just going, okay, I'm going to go and put in the POC circuit and stop halfway and produce MHP that had a payable that was probably less than what a concentrate was getting anyway. So why invest all of that capital at this point in time? You really need to take it all the way through. Now, whether that's sulphate or whether that's producing cathode or anything like that that can trigger that premium is fine, but you've got to have the right market. And I just feel like where we were, and particularly with where the equity markets went back in January, February, there wasn't really the right set of conditions for us to be pursuing that downstream path at this point in time. I think to Scotty's point, like, it will happen, and like but the North American and the European markets really have to get a lot more active first before you can really go back and look at that too actively.
Dan?
Yeah, I'll butt in. Look, this is all geology, right? So the deposits are changing. So when you go down the curve, the grade curve, the MgO generally goes higher. So the big deposits, I'm not talking laterite, I'm talking sulfides, need a different route to treat. Coming back, if your con is good enough to go to a smelter, that's probably the cheapest way you need to go, and let them deal with all the rest, the Vietnam or whether it's China or whatever. Unfortunately, we are not going to get those 5% deposits. You might get the odd 2.5%, 3% up in Kambalda, maybe up in Canada. But generally speaking, the world is moving into a low-grade nickel. And if we want to mine them as we're doing, the big project in Canada, they're all linked to the back-end refinery. So I think somebody commented in the last couple of days that the whole of the Western and the North American dream is actually wrong. They're building gigafactories without mines. So come back to mining. We need to demonstrate that we can produce the con commercially, and that means you just produce a dirty con. Now, back in the good old days, that was a dirty word, right? There was no such thing as a dirty. But today, dirty con means you need Hydromet to go through that process. And we've all done the sulfate equations, IGO, Wyloo, blah, blah, blah. Nickel West actually got one in Kwinana. But at the end of the day, the end dream will be that you do a deal with a strategic that needs the product through the refinery, one-step process into the battery PCAM. There's no sulfate. Sulfate at the moment is actually probably is falling off the rails. There is no real demand for sulfate. As Darren said, there's no benefit at the moment. So most people, Jinshuan, the big guys in China, are actually pushing straight through to PCAM. And that's why, Vietnam, low power costs, get the product in, and dirty product, because that's what the world's going to produce, and that's what we will need to deal with.
Joel, obviously, Wyloo and IGO, as Dan mentioned, pursued the downstream strategy. Where can you give us an update on where that sits and why it sits?
Yeah. No, at the moment, maybe I'll firstly touch on why we looked at doing that. To Dan's point, we kind of took a step back and said, at the time, sulfate was in vogue and it was all very sexy and it was getting a premium, which no longer exists. We sort of took a step back and said, you go to all this effort to crystallise your sulfate, and then it ends up at a PCAM plant. The first thing they do is dissolve it. So we thought, well, that's a crap idea. Let's keep it in solution, pipe it across the fence, and straight into a PCAM plant. So that was the genesis of the discussions with IGO. Has other benefits like deals with your arsenic content and things like that. It changes the way you would mine. But as for the status of that, the nickel price crash hit us at a relatively unfortunate time. We're in well-progressed discussions with a strategic who operates in that space. Neither Wyloo nor IGO have PCAM expertise in-house. We have a certain amount of refining expertise, but then we acknowledge this is now no longer our sort of place to play. So we're looking at partnering with a third party strategic in that area who needs the product. The nickel price happened when it did. Obviously, IGO's updates with Cosmos, our own mines went on care and maintenance. So we've kind of taken a breath, we've done a lot of work jointly, done a lot of work around commercial structures and financial models. It's not easy. It's certainly not easy with the price where it is today. Again, one of our interests, being a private company, it's slightly different outlook that you can. Large infrastructure-like projects like that, you don't get these huge fluctuations like you do when you're just selling a straight commodity. It tends to be a longer life kind of infrastructure-like yield to what is effectively a family office. That's quite an attractive thing, so that's interesting for us. But we also have to make sure that what we're doing has the life to justify it as well. So that's where we're at the moment, just taking a beat, ourselves and IGO, waiting out what is a difficult time in the market, and it allows us to continue doing the testing, and we're fairly well progressed. I guess the other answer to the question is putting on my North American hat. It's a bit of a different story and a different incentive for our asset in Canada, which is in Northern Ontario. Again, there's a whole battery ecosystem. Dan, you made the exact complaint I've said all the time. Everyone wants to own a gigafactory. No one wants to build a mine. Completely unbelievable that there are billions of dollars investing in gigafactories in southern Ontario, and that there is the mineral wealth that province, that country has, and there isn't this midstream supply chain yet. So we saw that as a real opportunity, and when you have a generational asset like Eagle's Nest, it makes sense to look to the future. And certainly hydromet and the battery pathway we think is the future for nickel. So slightly different incentive in North America, whereas in Australia it was more of an idea of how can we export something with the highest value density, how can we export the highest value, lowest volume product, and we thought that was sensible to be precursor. So you haven't heard the end of us on that one, but it's certainly in a bit of a pause at the moment.
Great, thanks. Josh, thanks for the question. Have we got any other questions? We've only got a few minutes left, 10 minutes or so. Just me to do the work. Andrew, we didn't touch on laterites. I mean, is MHP a final product and always will be for Gungari, or have you pursued other opportunities for value addition?
We looked at a range of different end products, and as some of the other panellists have made the point, back in the day, nickel and cobalt sulfate sold at a premium to LME. They don't anymore. in the end, whilst you can't speak for Nickel West, was there value in them producing nickel sulphate in Kwinana? I would say probably not, but I'm sure it was a good idea when the business decision was made. So we're very focused on initially producing an intermediate, whether that be MHP or MSP is currently under consideration as part of the definitive feasibility study and subject to detailed discussion with the consortium, but we're very focused on not trying to go too far downstream too soon. There's absolute specialist IP and experience involved in going downstream, producing CAM and PCAM, and we're very mindful of not getting ahead of ourselves. We've got to do what we say first, producing an intermediate product, and then because we've got such a large-scale, long-life project, we can look at other value-adding opportunities, but we feel it's very important that we go one step at a time, do what we say we will, and then look at other opportunities in the future with our partners.
Thanks, Andrew. Scott, you're probably in the opposite camp in Vietnam. There's an end-use industry, a burgeoning car industry that's looking to move into that EV sector. Does that drive your decisions?
I'll be honest, the government policy in Vietnam drove the decision. So there's a tariff on concentrate. So if that tariff, so it's a 20% tariff on concentrate, which effectively makes concentrate uneconomic. If that tariff wasn't in place, we'd probably be a concentrate miner as we speak. But so we were pushed in the right direction, I believe, and similar to what's been happening in Indonesia. In a low-cost jurisdiction like Vietnam, we think it's probably one of the best places in the world to go downstream. So from day one, we said, why not? And the Vietnam government has rolled the red carpet out and said, go for it, guys. And so we were pushed in the right direction, but very quickly we realised that, unfortunately, the battery chemical downstream players can't actually do much with a concentrate anyway. So it was a very easy decision for us because first we were forced to do it, but then our customers needed a downstream chemical product like an MHP or an MSP. They actually don't have much ability to do, particularly in South Korea and Japan, to deal with a concentrate. So it was an easy conversation and a decision for us to go into this downstream business because of that low labour cost, low power costs, and we believe even if we didn't have a heap of nickel in Vietnam, it's probably one of the best jurisdictions in the world to go downstream for nickel.
Thanks, Scott. Darren, what about Brazil? I mean, putting aside your discussion points earlier, with where it is in its history, growing as an emerging market and as an emerging power in not only in that region but globally, will the geopolitics of the region change how you might be able to approach downstream and value addition further down the track?
Yeah, Brazil's in a pretty interesting spot. It's in theory, it should be the first product that people go after, given where it's located into Europe and North America, but it's not a free trade agreement country with the US. So you've got this dichotomy going on right now as to how they play it. Brazil as a country is pretty much staying like Switzerland. They are staying neutral, they're staying friendly with the Chinese, but they're also still trying to stay close ties with the US. There has been talk that there'll be some form of limited free trade agreement between US and Brazil that might even get announced at the G20 summit that's coming up in November. It wouldn't be a full free trade agreement because of the agricultural side of things that are super important to both countries, but they may still be looking at doing something on the commodity side because there is a big lithium industry there. Obviously rare earths are a big part of Brazil now. Again, rare earths don't work in the price environment that exist, that's been created by China, so there needs to be alternate markets. And so we're seeing a lot of that sort of happening on the sides, but not really crystallising yet. For us, we find it's a fantastic place to be operating, trying to bring up an asset, particularly in the Carajás Mineral Province. It's been operated by Vale up there for 40, 50 years, a lot of infrastructure, everything's there to make a mine happen. And you've still got a reasonably proactive government as far as policy and where it goes, 15% tax rate. Everything that you need to actually get a project up and running is right there, which ultimately leads to the cost position that we've got for Jaguar. So yeah, look, feel very fortunate, over 1 million tonnes of contained nickel metal in an open pittable deposit, right sort of infrastructure, right cost structure, right ESG footprint. So, that's why we're getting very strong interest from the partnering side of things. And I'd expect that it's a project that starts its build, in the next couple of years. So,
great, thanks. We've got time for one more question. I've got a couple still here to go, but thank you, Matt. Thank you very much for that. I'll buy you a beer afterwards.
Thank you. Just touching on markets, etc. There was a comment a few minutes ago that the LME missed the opportunity to introduce environmental and green aspects to their market. Do you believe that was controlled by the owners of the LME? Secondly, with so much of the nickel market locked into long-term contracts, which are very opaque, does that add to the volatility of the free float on the LME and observable nickel markets, thus increasing the volatility when the underlying health of the nation is actually far better than what would be assumed from the LME daily spot prices?
Geez, Darren, you started that conversation. That was a really massive question. God, is that a political question or is that a commodity question? Look, I think the bottom line, before Darren, because he started the conversation, look, the LME back in the day with stainless steel was the market to go to. Then we had nickel pig iron back in 2009. We changed the whole fundamental of the nickel pricing system because China was the biggest user. Now you've got China, Indonesia, who's controlling the majority, plus, obviously Norilsk. Yeah, I mean, the LME is a good base benchmark for international trading, but I don't think it's going to be, at the end of the day, where you're going to get green premiums flowing through because, as you say, the people that use nickel, I go back to people who produce guns and cigarettes and oil. I can't see how people just change, the boards and the shareholders don't want dividends and they don't want this and they don't want that. So ESG was over here. It's now coming back to a more moderate sort of position because people said, hey, hang on, we're not making any money here. You can't run a business if you're not making money. So ultimately, commercial comes into play and says, we do have to look after the environment and we do have social community and absolutely 100% behind that. But business has to run on a commercial value. You can't run a company, and the LME will sell nickel to people that need it. And as we've all said, if you can't sell an electric vehicle and make money, what are you trying to do? I'll just go and buy my V8 diesel, which is most of what Canada's doing. There's very little EVs running around Canada, well, especially British Columbia. They're all pretty big V8s. So anyway, over to Darren.
I think, to your first point, I think there's definitely a bailout there, but I actually had this conversation with some people in London last week at LME, and whilst it might have been a bailout for the Chinese that were on that side of the short position when all of that happened in 2022, the other side of it was that the big banks were enormously exposed and they needed that as much as anyone. So that would have been probably more painful for the market if it hadn't happened. That's created a loss of liquidity. The liquidity has come back because they've made it easier for certain suppliers out of Indonesia to get accredited. What was normally a 2-year process became a less than 6-month process. And as I said, it probably missed the opportunity of, okay, we might make that timeline shorter, but you've still got to have these right credentials associated with that supply. And so for me, that's part of it. I think to the second part of your question around, the long-term contracts, the more that we speak to the traditional smelters, the more you understand that those long-term contracts are there. They still need the LME as part of it, so I think it was always about that pricing mechanism couldn't fail, even though there will be other, and there's a much broader market now, different products, different customer bases, etc., very, sometimes more direct communication. I think without the LME, the whole sector would be stuffed, to be quite honest, because it needs to have some central reference point just for everyone to be comfortable with. Now, others might have a different view to that, but for me, that it still was important that you had a pricing mechanism that everyone could point to and touch and feel and know where everything's going. We do see firsthand that these long-term contracts are there. The traditional smelter market is very tight. I think there's a lot of groups there that are short nickel units for their supply. I mean, for me, I can just talk to the Vale situation a little bit. We bought this asset off Vale. They had off-take rights. They wanted to deal with them, but they always maintain that they've got enough supply feeding their smelters from their own operations, but the mining side of it is the bit that always leaves them short. And that historically, they've always been trying to fill the mill from other sources because they haven't had enough of it coming out of their own. And I know this digresses even a little bit further, but I think the other thing around the funding, I think it was someone raised the point, is it's very true that all of this money is going into processing. You look at all the DOE funding that's being rolled out, it's all about processing. And whilst it's not about sort of talking to other companies' positions, but you take someone like Talon in the US, they've got a mine, probably got a very good deposit. They've got $150 million sitting ready to come from the DOE for processing, but they can't get through the environmental approvals on their mine. So this is the mismatch that's actually happening, and that's something that needs to be resolved.
Great, thanks. Joe?
If I could just make a quick comment more on your second question around, does the LME misrepresent the sort of health of the sector? It is an imperfect but good reference point, an essential reference point for many decades, but by its nature imperfect, because you've got stockpiles and trading of 4 nickel products, briquettes, plates, pellets and rounds, that govern, that functions as sets the benchmark price, that governs the pricing of the dozen or more different nickel products that are traded worldwide. So yes, it's not a perfect system, and the hard thing is, well, what's a better system? And I think that's what Metals Hub and groups like that are starting to work towards. I always use, my colleagues are going to hate me using this analogy because they've told me not to use it in the past, but I'm going to give it a shot. I always say it's like the price of Margaret River Cab Sav crashing because someone's producing too many sultanas. Like they're both grapes, but it's just vastly different quality and different purposes. And I think that sort of sums up the challenges with the LME. It's like it's helpful, it's necessary in many ways, but it's by its nature an imperfect smudge of the health of the industry.
Great, thanks, Joel. Well, unfortunately, we've run out of time. I see the cheese platters are out, and hopefully there's still bottles of wine on the tables and beer still going around. But I think it's been a fascinating discussion. There's a lot of questions we never even got to, but thank you very much. Can you just join me in thanking Scott, Dan, Darren, Joel, and Andrew?